The CEOs of the nation's largest banks are testifying right behind me, making their case against the proposed capital requirements, saying it would hurt lending, it would hurt the economy, and it would increase inflation. Here for reaction, I would like to bring in Meredith Whitney, CEO of Meredith Whitney Advisory Group. You were just down there in the hearing listening. Your reaction?
It's a very expensive meeting, right? And it's probably a misallocation of time for these guys, but they show up on the Hill every year to do this event. Look, they've made their case very clear. This has taken 10 years in the making, and it's absolutely ham-fisted. I'll quote Jamie Dimon, who said that proposing and then studying later is a very dangerous strategy. And what they mean by that is they're asking these questions about what Basel III Endgame increased capital will do to lending, specifically lending to small businesses and low-income consumers. And it's bad, right? Because as you drive more banking out of the regulated banking system and into the non-regulated banking system that isn't required to invest in the Community Reinvestment Act, you have more of that going to predatory lenders, and lending will just become that much more expensive. And I think that's what you've seen over the last 10 years, 12 years, whereas these guys used to dominate the mortgage industry, and now 70% of the mortgage industry is done outside of the banking system. So that's just one example. One of the things that they talked about is access to mortgages for first-time first-time home buyers, which has been a really an area that I've been focusing on for the past year, which is mortgages and homeownership is, at the lowest it's been in terms of for younger individuals, and homeownership. The average homeowner is getting older and older and older. So it's a very important issue, and should be a very important issue for these senators because that's their constituents. Yet the proposals under the system, under the Basel III endgame proposal, are going to hurt the consumer. That's just a fact. One thing that impresses me is how politicized this has been, in terms of you have senators only showing up when they're going to be on camera, and the senators that are in the room aren't paying attention. And so when the CEOs were giving formal presentations, you had senators moving around and talking to each other. So this is why I'm here, because you need to read the room, and it doesn't seem as if the proposers of this really damaging legislation are taking it that seriously, whereas the impact for the banks at hand is significant.
You think this is going to create more risk in the financial system? You mentioned the notion of a lot of activity moving out of the regulated banking sector.
No, I don't think there's going to be risk for the system. I think the risk is for the U.S. consumer, which is going to be, capital is going to be harder to come by for small businesses and the individual, and it's going to be more expensive. So that's the risk. It's not systemic risk by any measure. I think within the banking industry.
How much more expensive are we going to see mortgages as a result of this? How's that going to impact housing?
I think you could see. Well, for starters, I think this is for first-time buyers. So housing, I think, is going to go down. We've discussed this in 2024, because I think that what now is a demand-supply imbalance is going to invert, and it will be supply-demand imbalance. And 40% of homeowners don't have a mortgage, and those are the older homeowners. These are what we're talking about in terms of it's first-time buyers and the availability of mortgages for them. Mm-hmm. I think you could see, it depends on where rates are in terms of the percentage increase, but where they are now, a 25-30% increase in mortgage rates.
Okay, so then, given that, it seems like this is going to cause more harm than good. Do you think that these capital requirements are needed? Should they be completely started again from scratch?
I want to explain something in the simplest terms. So banks have been, since the crisis, required to increase capital, and it's sort of a layer on of capital. You have the SIFI buffer, you have the regulatory capital that they've always had to have, then you have the SIFI buffer, and this proposal is basically 25% increased capital on top of that. Now, the Basel III Endgame, which will apply to the European banks and all non-U.S. banks, they're starting from scratch with that. So you're adding that level, an additional level to the bank's capital that they're already well capitalized. So I don't think that any of this additional capital would have prevented Silicon Valley bank failure or there anything necessarily systemic. What Brian Moynihan, CEO of Bank of America, said is basically the increased capital proposal will just require the banks hold more capital and lend the equivalent less capital out in the system. That doesn't help anybody. And I don't think that's what American consumers or voters want.
There's also talk about a lot of this higher capital flowing through to hedging that is going to hit the consumer. Do you think that this proposal will be inflationary?
This is exactly what I was talking about. Inflationary insofar as cost of capital will just be higher. So that, from an inflation standpoint, from that perspective, yes, in terms of it'll be more expensive for many people to access credit.